Welcome back to the Explainer series on ASC 220 Comprehensive Income. We're diving right into Section 1 today, what it is and why OCI even exists. Look, if you really want to gauge a company's financial health, just staring at net income is honestly a trap. You absolutely need the complete picture of how that company's equity is shifting over time. If you miss pieces of this puzzle, your view of what the company is actually worth gets totally distorted. So we're going to dig into how we measure literally every single dollar that adds or subtracts from a company's value and exactly how we organize it so it actually makes sense. So here is our quick roadmap for this explainer. First, we'll look at the complete equity picture. Then we'll compare net income directly with OCI. After that, we'll talk about solving earnings volatility, and we'll wrap up with the strict scope of ASC 220. All right, let's jump straight into Section 1, the complete equity picture. Because when we're analyzing financials, what we're really trying to measure at the end of the day is overall value creation. And that brings us to the core definition. Comprehensive income is the total change in a company's equity during a period from all non-owner sources. Basically, we're excluding things like issuing stock or paying out dividends to your shareholders. Instead, we're capturing every other dollar that moves the needle on the company's net worth. We're talking about standard day-to-day operations for sure, but also things like exchange rate movements, changes in the value of certain investments, or updates to pension funding. All of that changes the equity. But here's the really critical part. Not all of this value change flows immediately through your traditional income statement. Some of those items actually have to be deferred in equity for a little while, creating what we call Other Comprehensive Income, or OCI. Now, we need to be crystal clear on the rules here. ASC 220, the standard we're focusing on, does not decide what goes into OCI, and it doesn't decide when it gets put there. Other individual standards make those calls. ASC 815 for hedges, 830 for FX, 320 for investments, and so on. What ASC 220 does do is govern exactly how to display OCI. It dictates the presentation, the format, tax effects, and all the required disclosures. Think of it like a traffic cop. It just makes sure the information is presented clearly and consistently to anyone reading the statements. Moving right along to Section 2, net income versus OCI. Let's break this master metric down into its two distinct parts and see how they play together. Think about the stark contrast between standard daily operations and these deferred items. On one hand, net income contains your revenues, expenses, gains, and losses from normal realized operations. That all wraps up neatly at the bottom of the income statement. But then consider the deferred items. Other comprehensive income contains very real changes to equity, but they bypass current earnings temporarily. They just sit there until a future trigger releases them. And then, bringing it all together, comprehensive income is simply net income plus OCI. It's the absolute total change in equity from those non-owner sources we talked about. To really get your head around this, just think of OCI as a waiting room. It's a great analogy. Certain gains and losses just aren't settled enough yet to hit net income. They haven't been fully realized in a strict economic sense. So they sit. They wait. They stay in this holding area until a very specific event pulls them into earnings. That could be the settlement of a hedge, maybe selling off a foreign sub, or a scheduled pension amortization. But when that specific trigger event happens, they're called out of the waiting room and they reclassify from OCI into earnings. And they only do this once. So why go through all this trouble? Well, that brings us to Section 3, solving earnings volatility. Let's look at the actual systemic problem that OCI was built to fix. Imagine a world without OCI for a second. Every single fair value swing on a hedge, every minor exchange rate blip, every actuarial pension update, it would all crash directly into your net income, immediately. You'd end up with these wildly volatile earnings that honestly have nothing to do with how well the company's actually running. Let's look at a realistic scenario. Say a company has a 5-year interest rate swap, designated as a cash flow hedge on variable rate debt. In year 1, interest rates drop and boom, that swap gains $50,000 in fair value. But, and this is absolutely key, no actual interest savings have been received yet in cash. So, should this $50,000 paper gain show up in year 1 net income? Absolutely not. Not yet. The actual benefit is only going to be realized as those hedged interest payments are made over the next 5 years. And this brilliantly illustrates exactly why OCI exists in the first place. Without it, all those fair value changes just wreck your net income immediately, creating massive volatility from sheer market noise. It makes it practically impossible for an analyst to separate the core operating performance from random market fluctuations. But with OCI, it acts like a massive shock absorber. The unrealized items get deferred, your net income stays stable and actually reflects operations, while the volatility from things that haven't been realized yet is safely held aside until the economics actually justify recognizing it. That being said, definitely don't mistake this waiting room for a black hole, okay? OCI is not some permanent hiding place from the income statement. Literally, every single OCI item will eventually reach net income. It just has to wait for its specific trigger event to happen. Remember, these items are deferred, they are not permanently excluded. Okay, so now we know what it is and why we use it. But who actually has to do this? That's Section 4, the scope of ASC 220. The rules governing this are extremely strict under US GAAP. If you are a US GAAP entity with OCI items, you are absolutely required to present this. No getting around it. Now, if you're an entity that only presents a balance sheet, you're exempt. But that's simply because there's no net income to begin with. What about not-for-profits? Yes, you are also required to present this, although you'll follow the ASC 958 format and use some NFP-specific terminology. And please note this carefully. There are 0 private company counsel, or PCC, alternatives for this. It is a universal requirement across the board. And that leads to a highly counterintuitive rule, which honestly is a pretty common trap. What if you are a US GAAP entity, but you have exactly 0 OCI items this period? Nothing in the waiting room at all. You'd probably think you can just skip the whole disclosure, right? You absolutely cannot. Even if the waiting room is completely empty, you must still present the comprehensive income statement showing 0 OCI. The requirement to present it doesn't just vanish because the balance happens to be empty. In that case, comprehensive income simply equals net income, but the presentation format itself has to be maintained. Okay, let's do a quick high-energy recap. Comprehensive income is your master metric. It captures all non-owner equity changes, giving you the true, unfiltered picture of a company's shifting worth. OCI acts as that temporary waiting room for unrealized gains and losses, which perfectly functions as a shock absorber to protect your earnings from misleading market noise. And finally, ASC 220 applies universally under US GAAP, dictating exactly how we present this info, even if that OCI balance is 0. We know that items don't just stay in the waiting room forever. They're waiting for something very specific to happen. So I'll leave you with this question to chew on. If OCI is the waiting room, what exact triggers finally open the door to net income? What are the specific categories of OCI, and what economic events actually cause them to reclassify? Well, that is exactly what we're going to uncover in our next explainer when we break down the key terms and the 4 OCI categories. Thanks for tuning in, and I will see you in the next lesson.